Welcome back, legends. I'm Dr. Cal, and let's get right into today's video. It's 4 a.m. my time, so please, legends, if you appreciate these videos, smack that like button right in the face on your way in. So let's get right into it. All the indices are in the red. Stock market map red all over the place, with the exception of defensive healthcare. Different sectors all red today. Defensives, utilities, healthcare did the best this week, so this is a full-on risk off move, selling of high risk assets and rotating into defensive assets. And even with that rotation taking place, all the sectors are in deep red today. Huge, absolutely massive development on the daily chart, legends. Today we hit our 431 target. If you've been watching over the last week or so, you will know that we've been waiting for the stock market to hit this downside target by the end of September. We still have one full trading week ahead of us, in addition to tomorrow's Friday session, and we've already hit the 431 target. This is a major target because it's the gap fill target from June 26th. The market formed this bottom and rallied, left this gap unfilled until today. This gap has now been filled. We're also less than 1% away from tagging this major support line. Why is this trend line so huge? Why is it so important? Well, this trend line captured every single major bottom this year, and we're pretty much there this week, just 0.5% away from tagging it. We still expect the end of October target to be 420 to fill this gap left from mid-June. This gap is also present in the futures market. It's exceptionally rare for the futures market to leave gaps like this, but this gap is also present in the futures. Here it is, legends, exact same gap left from June 8th at 4,300 on the SPX futures. Now, in addition to this absolutely huge development of filling the gap of 431, there's also a massive development on the futures. This is the 4-hour futures, and I need to point something absolutely critical. Notice this, legends. We haven't been this oversold on the RSI since the June bottom of last year, and we'd have to go even further back to see any reading this low. We have to go back all the way to the October bottom of 2021. What does the historical precedent tell us about these major bottoms, these major sell-offs? Well, pretty much, legends, every single time we went down to an oversold reading this deep below the 18 reading, the market did only one of two things. One, it either moved sideways, then formed another low, a lower low, and established a double bottom with a positive divergence, a higher low on the RSI, corresponding with the lower low on the price action. Or it did pretty much the same thing, but produced a slightly stronger counter trend rally, then came back to produce a lower low with a bullish divergence. So based on historical precedent, even though we only have two data points here, the market did pretty much the same thing twice. It had a counter trend rally. In June, it was very anemic, a sideways move, then a lower low. In September of 2021, it had a stronger counter trend rally, but it still came back down to form a lower low with a bullish divergence. That gives us a very clear target of 4,300 on the S&P 500 futures for something like this to take place. Either a counter trend rally and then a double bottom, or simply a sideways chop, then a lower low and a double bottom. In either case, we're looking at this 4,300 level to get filled. This is a more clear picture on the daily chart. I wanted to point out that the market very rarely leaves gaps like this. This is a massive gap from yesterday. It is extremely rare to see gaps like this left in an uptrend. When we leave a gap like this, we usually fill it just one day later. In a downtrend, we often get a capitulation move with a major bottom forming at the end of that move. Based on how extensive the selling ended up being toward the end of the day today, we're likely witnessing a huge capitulation style crash with a major bottom forming at the end of this down move. We have two clear targets. This is the first target at 431. The second target is below at 420. This trend line might still act as potential support, so we could see something like this, a tag of the support line at 425, 426. Remember yesterday, legends, I downgraded the downside target from 431 to 425 after we saw that huge breakdown candle post-Fed meeting. These are the revised projections that I discussed on the hourly chart, down from 431 to 425 by the end of September. 420 remains the ultimate downside target by mid-October. Based on how the market behaves toward the end of September to end the month, this target can also be downgraded, so we remain extremely cautious throughout this seasonally bearish time of the year. Also discussed this double bottom forming on the oscillator. We usually get a lower low on the second bottom, right? Something that looks like this. And often we get the bottom after that double bottom is complete. We often get the bottom after that double bottom is complete. Let me draw a vertical line so you guys can see what I'm talking about. Here we go, a lower low that corresponded with the March bottom. In this example, that lower low corresponded with another low forming a couple of weeks later with higher low on the oscillator. This was a very obvious double bottom with a bullish divergence. We saw pretty much the same thing happen in June. We had a double bottom here with a lower low. The market ended up putting an even lower low with a bullish divergence, a higher low on the oscillator, and that corresponded with the final bottom. That's still my expectation, the oscillator to form another huge bottom and the market to complete a bottom at the low of this second sell-off or just a couple of weeks later. We still have the 200-day moving average ascending. We have this key level of resistance, a prior level of resistance will now likely act as support. We have the 422 gap fill, and we have another level down here that will act as support. It acted as resistance here, support here, resistance again, and will very likely act as support. If we fill the gap at 422 and continue lower, our next and potentially final stop is going to be at 417. Let's discuss the Nasdaq 100. I discussed this major break of the trend line in the last video. As soon as we had that break on the Fed meeting, it generated this 10% downside target on the Nasdaq. It's a minimum downside move, and that target is my expectation by the end of October. We can go even lower, just like the S&P. If we fill this key gap at 332 and continue lower, the second level of support is this. It acted as major support here, resistance here, and it will act as support again. That level is at 320. As of right now, the target remains at 332. We'll see how the market reacts at that low in October. And at that point, we will determine whether we should downgrade that target to 320 or if it should remain at 330. As of right now, downside target by October is 332 on the Nasdaq, 420 on the S&P 500. Downside target by the end of September is 426, 425, 426 on the S&P 500. By the end of September, right here, for this level to act as support, remains 420 by October. We could downgrade that target even further if we continue to see significant weakness. Let's take a closer look on the 1 hour chart. We have already filled this gap, finally filled this gap at 430, 431 to be exact. This was our downside target all along, and I've talked about it for weeks and weeks and weeks. In fact, if you go back to our video 1 week ago, I discussed this exact setup. Remember the 20th of September. I highlighted this major break in seasonality that is expected to happen on the 20th of September. And what do you know, legends? This break happened exactly on the 20th of September. This entire crash sequence began yesterday, just as seasonality warned us it would happen. Unfortunately, seasonality tells us more downside is expected. That's why I ended up downgraded the downside target on the S&P 500 by the end of September from 431 down to 425. We have to let the charts speak to us, legends, and show us what the market wants to do instead of trying to predict what the market wants to do. The fact that we did not get any reactive rally on the Fed day back to at least the bottom edge of this gap told us that the market was far more bearish. The fact that the Fed served the market that poison pill of raising the projections for the interest rate target for next year and the year after by 0.5 percentage point, essentially telling the market, get used to it, no rate cuts. Don't get your hopes up higher for longer. These rates are here to stay. With that said, legends, this is a very important trend line. We could still get a reaction off this trend line from our downgraded target, with the market likely trying to find buyers in this demand area corresponding with this trend line. We could see a reaction here with a counter trend rally that fails, fills this gap, then fails, comes back down to form that lower low with a positive divergence that usually develops whenever we see an RSI reading below 18. Exceptionally rare. Only happened twice in the last 2 years, and ended up with the same structure: a lower low on the price action, higher low on the RSI, forming a major bottom, a major double bottom with a positive divergence in both cases. Let's jump to the bullish percent index. I keep harping about this because it's absolutely important, very critical. Whenever we get a break below 38.4, we always get additional downside, additional weakness comes through. The only exception was the May reaction. That was the only exception. In every other instance, whenever the market dips below 38.4, we get additional weakness. That's in line with my downside target of 425 by the end of September. This is the gap that I'm talking about, 4,300 on the SPX. It also ties in with that double bottom that usually develops whenever we're below 18. So that gives us a solid target to look at, 4,300 on the futures market. Let's talk about the VIX. Very important development on the VIX. Yesterday, it broke above the 50-day moving average. This is a green line. Whenever the VIX is above the 50, the market is in a downtrend. Whenever the VIX is below the 50 moving average, the market is in a major uptrend. Yesterday, we officially entered a new downtrend in the market with the VIX breaking and closing above the 50-day moving average. Nasdaq 100, a major break of the trend line happened on the Fed meeting day. First downside target 355, getting very close to it, likely getting tagged tomorrow. Our target by October is 332 to fill this gap, and just like the S&P 500, this downside target can be downgraded to 320 to this prior reaction low and these prior reaction highs. Dow Jones also broke that key trend line. All of the indices are now breaking down. Same thing on the Russell 2000, broke below this key neckline. This is an important neckline because it demarcates this head and shoulders pattern. A break below it confirms this head and shoulders pattern and actually gives us a full measured move target from the neckline all the way down to 164. That goes back to the 52-week lows for the Russell 2000. High yield bonds, smart money up top, dumb money, S&P 500 down below. We took out, burned through this bullish divergence. This is exceptionally rare. We almost never burn through these divergences, which again tells us that this is no ordinary sell-off, as confirmed by the oversold status. We haven't seen anything like this for over 1 year. Yield bonds can still establish a bullish divergence if we end up forming a higher low versus the July 6th low. Not there yet, no sign of a buy signal anywhere. XLY divided by XLP, consumer discretionary divided by consumer staples. This is the barometer for the health of the stock market. You want to see this ratio trending up whenever it is trending up. The market is trending up whenever it is breaking down, as it has done so recently with a double top, with a bearish divergence. The market is in a downtrend. This looks at stocks like Tesla, like Amazon, etc. This double top with a bearish divergence actually gives us a full measured move. Let's see, all the way down. Look at that, to the 200-day moving average. That means expect stocks like Amazon, Tesla, etc. to tag the 200-day moving average relative to the defensives, which means more downside is ahead. Let's see how much we're talking about. An additional roughly 11.5% lower than the staples. So if we assume the staples don't decline at all, we're talking about 11% down, Amazon, Tesla, etc. S&P 500 relative to gold. I use this chart to mark risk appetite in the market. Whenever we get a buy signal on this chart, the market begins to trend up and rally significantly. So far, we had a perfect breakdown on the 20th of September. Remember the 20th of September. It came and it came with a vengeance. It burned through this very weak buy signal. I discussed this a lot in the last few videos. I said I'm not buying this buy signal. It is very weak. I need to see big green bars on the histogram. We never got that. That's why I never considered this a buy signal. Now we have a major sell signal. CPC buy and sell signal. The only light at the end of the tunnel is the fact that the CPC put to call ratio buy and sell signal is declining. This is a sign that a bottom may form soon. The buy signal is only triggered once we hit 1.1 and come back below that level with the PPO producing a cross down. This always corresponds with a very powerful buy signal. Not there yet, but this is the only light at the end of the tunnel, seeing that the CPC is slowly declining. NYSE, McClellan Volume Summation Index, still moving down. Oscillator, we expect a huge lower low on the oscillator here, just like these prior lows here, and again, these prior lows here. We don't expect a tradable, meaningful long-term or medium-term bottom to form until and unless we get a huge second dip on the oscillator here. We are forming that right now. It is still in progress. Nasdaq Summation Index. This is the Nasdaq Composite up above, getting very close to hitting our first target, 13,200. The second downside target is 12,500. Summation Index continues to point straight down. Oscillator is expanding, which is in line with all of the prior sell-offs that we've seen this year and last year. S&P 500 50-day breadth. This measures the percent of stocks in the S&P 500 index trading above their 50-day moving average, declined to 18% today. This is a huge breakdown. We're back to the March lows. We'll likely go all the way back to the single digits, just like these major bottoms, as indicated by that 4-hour RSI reading, telling us that this sell-off is no ordinary sell-off. It is capitulation selling, which means expect vertical declines falling off a cliff. And it's exceptionally risky to try and guess a bottom here with these huge gaps forming. Wait for the market to form proper structure. We will have to wait for at least several candles of sideways movement. That usually forms the first low. Then we get a breakout and a double bottom, and that usually corresponds with the final bottom. Now we have to wait for periods of sideways consolidation, several trading days of sideways moves. We haven't seen any of that just yet. What about the 200-day breadth? Broke this key trend line. Look at this major trend line, meaning we'll likely yet again see low double-digit reads on the 200-day breadth, something that is more in line with the bottom in October and in June. So expect a lot of weakness still yet ahead of us. Fear and greed index, we have entered fear territory 40. I still expect extreme fear between now and October. Timeline, we took out this low, meaning we're not near a bottom forming yet. We often get a double bottom with a higher low that usually corresponds with a market bottom. The fact that we took out this low means that we are not near a bottom yet. Market momentum, we hit the 125-day moving average. In March, we broke through it and then recovered. In January, we broke through it and recovered. We might see that happen yet again with the market filling that key gap at 4,300 on the futures. Stock price strength moved sideways, then declined. This is very bearish. I cannot overemphasize how bearish in the market does this, moving sideways, fails to produce a breakout and declines. Same thing with breadth, moved sideways. It is now declining, likely in the process of yet again forming a double bottom with a lower low. Put to call ratio, only light at the end of the tunnel. Put to call ratio hasn't exploded to the upside. It is slowly rolling over. That is the only positive sign, so that something good will come out at the end of this major correction. Market volatility closed and broke above the 50-day moving average. Whenever we're above the 50-day moving average, nothing good happens in the S&P 500. We still expect more downside based on seasonality. The market usually bottoms at the end of September, then produces a counter trend rally to start October. That counter trend rally usually ends at the first week at the end of the first week of October, then a significant sell-off toward the end of October. That is usually the final bottom for the year, and we begin to make a lower high from that point on. To summarize, legends, we have multiple key developments. Number one, RSI below 18 on the 4-hour futures chart. That gives us an objective downside target of 4,300 on the futures. That objective target on the futures market corresponds with this small gap here at 426 on the SPY. This larger gap below at 422 on the SPY corresponds with 4,250, this exact level on the futures. That remains my target by October. This 4,300 target, 425 on the SPY, remains my target by the end of September. Additional key development today, we filled the gap at 431 finally. We are very, very close to tagging this trend line. Likely we'll find some support after we tag this trend line, fill this key gap on the futures, roughly around 426, 425 on the S&P 500. This key RSI development on the futures often corresponds with the market forming a lower low. That second low is the final bottom, and it usually develops a bullish divergence. That will be our sign to get back into the market. Expect that to develop over the next roughly 3 weeks. VIX above 50-day moving average means we're likely to see more downside and rallies likely to fail and reject, right? Any counter trend rally will likely fail and reject. Lower lows and lower highs from this point on is the norm. Sell the rips, don't buy the dips yet. My ultimate target by the end of October is for the VIX to hit 25. We're not likely to see this level on the VIX getting tagged until the S&P is at 420 or even lower. Be very cautious out there, legends. Don't try to guess bottoms. Let the market show you what it wants to do. It's very prudent not to force our opinions on the chart. Let the charts tell us what the market wants to do. Case in point, legends, when this breakout failed, when we failed to get even a rally to 427, the bottom of this gap, we immediately knew that the market is turning much more bearish than expected, and that warranted the downgrade to 425 by the end of September. We let the charts tell us what the market wants to do. We don't force our opinion on the charts. If you enjoyed this video, legends, smack that like button right in the face, just like Will Smith. If you watched till the end and did not enjoy the video, I thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.